In this video, we're doing a combination problem. Basically, we have a series of payments, so we have an annuity, and we also have a lump sum as well. And we're being asked to find the present value of all of that cash flow together. So we're going to basically separate it into two pieces and then add them together. Okay, so first, you are receiving $10,000 at the end of each year for the next 5 years. And in addition, at the end of the 5th year, you're going to get that $10,000 payment, but you're also getting a lump sum payment of $100,000. So the way to solve for this is first I go ahead and I put in all my information here, my payment, $10,000, my lump sum, my number of periods, and my rate. So in order to solve for this, basically I am going to first do the present value of the payment, the present value of the ordinary annuity. So I'm going to click on some formulas that I've recently used. I take my present value. And the rate, it's apparently annual compounding, so I don't have to do anything to it. The number of periods, I'll just go ahead and click that in there. I put my payment in as a negative to make this come out positive. The future value is 0. This is an ordinary annuity. We're finding the present value of a lump sum of payments, so we can leave that blank. And the type, this is ordinary. I'm going to leave that blank as well. So there's my present value of that ordinary annuity. The present value of the lump sum, I'm going to go ahead and use the present value again, and I'm going to plug in the same information that I need to, and the number of periods hasn't changed. The payment I'm leaving blank because this time I'm doing the lump sum. It comes at the end of the 5th year, so its future value is that. Oops, I did not put it in as a negative. Okay, I fixed that. So I did not put in my lump sum payment as a negative, and that changed the signs. So the present value of the ordinary annuity is around $36,000. The lump sum, its present value is 56 something. I add the two together. The present value of that stream of cash flows is 92,790. For situation B, I'm going to use very similar information, and basically you can just copy and paste everything right over here, and it should automatically just update all the fields. The difference is I'm using 8% as the rate, the discount rate, right? We're finding present value. So when I do that, the present value of the payment, the lump sum comes out there, and the sum is over $100,000. And in the third scenario, I've got the same situation, but I'm using a 10% interest rate. When I go ahead and plug in all those numbers and do that, I come out with $100,000. Okay, so what I'm trying to get at with this particular problem is I'm having you do bond issue pricing. And a bond basically is a series of payments. So a bond works like this. An investor will give the company money. In return, the company will provide interest payments at regular times. It's a stated amount. It's written on the contract, and at the very last, at the end of the contract, then they'll pay back the lump sum. And what happens is that sometimes the interest rate may change between the time that they printed the bonds and the time that they actually sell them. And in that case, basically we price the bonds in a way that the market will get the right return. So we cover this in a later chapter. It's in Intermediate 2, but for Intermediate 1, you're just being asked to go ahead and do bond issue pricing. You can read about it at the end of your chapter, but I just wanted to give you a little glimpse into what bond issue pricing is, but also just to see that there can be a combination of different types of payment streams. So like we said, we had an ordinary annuity, and then we had a lump sum. And so we just took the present value of each, added them together. There is a way to do it in a one-step in Excel, but I'll save that for when I see you in Accounting 302 in Intermediate Accounting when we cover bonds in more detail.